Hi, what's up? This Eric on Owen Finance, your gateway to the ever-evolving world of crypto, but also smarter investments, sharper financial insights, and much more. Ready to level up your financial game? Let's dive in. Bitcoin emerged around 2008, introduced to the world by an individual or group under the pseudonym Satoshi Nakamoto. This mysterious figure released a white paper outlining a new form of digital currency, a decentralized system that would allow people to send value to each other without a bank or any central authority. The launch happened in January 2009, right on the heels of a major financial crisis. Some say the timing was deliberate, as the world was seeing the vulnerabilities in traditional financial structures. Early adopters had little idea how big this concept would become, and for a while, Bitcoin functioned mostly as an experiment within small online communities. So, what exactly is Bitcoin? At its core, Bitcoin is a digital asset, often referred to as a cryptocurrency, secured by cryptography. It's built on a decentralized network, meaning no single entity, whether a government or a corporation, holds the reins. Instead, transactions are confirmed by a network of computers, or nodes, spread across the globe. People use Bitcoin for various reasons: purchasing goods and services, transferring money across borders quickly and, in many cases, at lower fees, or simply holding it as an investment in the hope its value will continue to rise. One of the key attractions is that Bitcoin operates 24/7, no bank holidays, no middlemen, and often lower transaction costs compared to traditional payment systems. Investing in Bitcoin has become popular because of its historical price appreciation and its limited supply. Only 21 million coins will ever exist. This scarcity aspect is a major draw for people looking to hedge against inflation. Traditional fiat currencies, like the US dollar, can be printed without a strict cap, potentially decreasing in value over time. Bitcoin, on the other hand, has a programmed rate of supply, and at some point, no more new Bitcoins will be created, giving it a scarcity similar to precious metals like gold. Of course, it's not all sunshine and rainbows. Bitcoin has seen wild price swings, and volatility can be a double-edged sword. While it has enabled massive gains for some, it has also led to significant losses for others. Additionally, while Bitcoin was originally touted as a hedge against inflation, real-world data shows it doesn't always behave that way in the short term. Critics also point out scalability issues and the environmental impact of Bitcoin mining. Mining is the process by which new Bitcoins are introduced into circulation and transactions are verified on the network. In the early days, mining was something you could do on a personal computer with a decent CPU. As more people joined and the difficulty increased, miners began using specialized hardware known as ASICs, application-specific integrated circuits. These machines are much more powerful, but also more expensive and require a lot of electricity. Today, Bitcoin mining is extremely competitive and often involves large-scale operations in locations where electricity is cheap. For those who don't want to invest in expensive hardware, there's the option of cloud mining, where you effectively rent computing power from a data center. However, this route can come with risks. Some cloud mining services are scams or simply unprofitable once fees are factored in. We'll explore mining in detail in a future video, diving into hardware requirements, profitability calculators, and strategies for small-scale versus large-scale operations. Behind the scenes, Bitcoin is powered by blockchain technology, which is essentially a digital ledger of transactions distributed across countless computers. Every time a new set of transactions is confirmed, it's recorded on a new block, chained to the previous one, hence the name blockchain. This chain is immutable, meaning it's nearly impossible to alter past transactions without rewriting the entire chain, which would require an overwhelming amount of computing power. The beauty of blockchain is that it replaces the need for a central authority to keep track of who owns what, making the entire system transparent and trustless. We'll be digging much deeper into blockchain mechanics, including consensus mechanisms and smart contracts, in upcoming videos. A vital part of Bitcoin's system is the concept of halving, where the rewards for mining new blocks are cut in half roughly every 4 years. This mechanism helps control the supply and, by extension, can influence the price. The halving events have historically been followed by considerable bull runs, though that's more an observation than a guaranteed rule. After several halvings since 2009, the block reward, which started at 50 BTC per block, has decreased significantly, and it will continue to drop until the supply limit is reached. These 4-year cycles have become somewhat of a focal point for traders and investors, with many anticipating price surges in the months following each halving. When it comes to price evolution, Bitcoin started out nearly worthless, literally fractions of a cent. In its early stages, you could buy thousands of Bitcoins with just a few dollars, and many saw it more as a curiosity than a serious financial instrument. Over time, key milestones included breaking $1, then $1,000, and soaring beyond $19,000 near the end of 2017. The price experienced a dramatic crash soon after, which caused skeptics to label it as a passing fad. But it rebounded and broke new records, rising above $69,000 in late 2021. After a few more dips and spikes, Bitcoin eventually surged past the psychological barrier of $100,000, proving once again just how unpredictable and resilient it can be. At the moment, it's trading slightly above $100,000, giving it a substantial market capitalization and further solidifying its place as a major financial asset. Predictions for Bitcoin's future value vary widely, from those who see it shooting to $500,000 or more, to those who believe the bubble will ultimately burst. Regardless, Bitcoin has demonstrated an incredible capacity for reinvention and longevity. Let's turn to the current environment in the United States, which has been especially intriguing for Bitcoin and the broader crypto market. Regulatory discussions are heating up, with the SEC and other agencies examining whether to treat cryptocurrencies as securities, commodities, or something else entirely. We've also seen some interesting debates in Congress about central bank digital currencies, CBDCs, and the role that private cryptocurrencies might play in the national economy. These discussions can create uncertainty in the short term, but they also signal that the crypto space is being taken seriously at the highest levels of government. What would it mean if the US decided to hold Bitcoin in its national reserves? It could be a seismic shift, lending massive credibility to Bitcoin as a store of value. Some argue it would make the US less dependent on traditional foreign exchange reserves and more flexible in international trade. Others believe it could introduce new risks, given Bitcoin's volatility and the potential for political backlash. As with many things in the crypto world, any move by major governments has the potential to greatly affect market sentiment, for better or worse. If Bitcoin became a strategic reserve asset, we might see a whole new wave of mainstream adoption and perhaps an entirely new stage in the evolution of digital currencies. Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you, and take care of yourself and your finances.